Hi, Steve Van Metre here, and welcome to your weekly economic update where we take about 30 minutes every Friday to try to make sense of the markets and take a deeper dive into the economic data to see if things make any sense. And well, they might be. Let's start off the gate. So China sent out an olive branch, and I don't have one, but nevertheless they said we're going to waive some of our tariffs on U.S. pork and soybean imports, and people are taking this as China wants to make a deal. No. China has a massive food problem. They had the swine flu decimate a third of their hogs, and they had two versions of the armyworm chew up a bunch of their other crops. They're rationing pork. Pork is a big deal in China. It's one of the most popular foods they want. And China's been, it's kind of like a vacuum all around the world buying up food because China can't make enough food for all their people, and they can't buy it all from one country. They literally have to go around country to country and buy as much food as they can. Believe me, this trade war is not helping them in that standpoint. So they decide to waive some of the tariffs on pork imports because they need them, and on soybean imports, which is now a surprise to some people because they were buying a lot from Brazil. Well, Brazil's got a problem thanks to the solar minimum called a big drought. And when you get a big drought, your crop doesn't come through. And guess what China needs? Soybeans. So this is not to be considered a moment that China is going to suddenly say, hey, we want to make a deal. They need the food. They desperately need food. Remember, going into this crop year, I said there's enough supply to equal demand. Change any dynamic, and you're obviously not going to change demand. I mean, unless a large part of the global population gets wiped out. Change the supply dynamic, you got a problem. And guess what? The solar minimum, right on target, is causing problems. So China needs to buy some of our stuff, and ag commodities look like somebody knew it because there was a bottoming pattern forming last week, and now we're starting to see prices rally. Following that today, we got the retail sales report, which people for some reason thought was really good. Now, retail sales over last month rose 0.4%, which is not bad. I mean, you could say, well, beat consensus. Who cares about consensus? When you take out automotive sales and gasoline sales, it was up 0. And this was after the Fed reported a massive spend in credit cards last month. Not something you really want to see. Wait till we look at the restaurant data. Now let's get into bonds. The headline topic of our update this week is the Fed's going to cut and bonds are going to rally. Treasury bonds are going to rally. Well, yields have been going up this last 5 to 7 trading days. And of course, people are like, oh my God, inflation's coming. And it's like, oh, good grief. It doesn't work like that. Now we're going to go through, and I've got a mountain of browser windows lined up to go through all the points that to give you the graphical version of what I wrote about in this week's update. And many of you who watch these videos have seen some of these before, but it's always just good to refresh your memory. Sometimes people get anxious when they start seeing things go not the way they want, and this happens in the market. It doesn't always go every day, every week the way you want. There's going to be periods where, one side, the sellers or buyers, depending on what it is, are going to dominate. So how do you handle this move? Do you panic and sell your bonds and say, oh, everybody's right, yields are going up for the first time in history? Not history in terms of ever, but in terms of in a rate cutting cycle. Do you just hold business, say, hey, you know what, it's cool, let it back up, I'm good? Or do you use this as an opportunity to increase your risk? The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as recommendation or solicitation by selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that I'm going to do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. So I'm going to let you think about what you would do. Which one of those three? And we'll get into this, and by the end, I have an idea of what your answer will be. Let's take a look at the money supply. We have not gotten that big deluge of Treasury borrowing yet. It was supposed to start this month, but it's looking like it's being delayed. I don't know why. I just literally read a report that said it's likely to go through mid-November. So it tells me at the moment that it may not even start this month. So the M2 money supply, the growth rate increased slightly to 5.46. The 6-month rate of change is sitting at a pretty hot. You double that and you've got a 7% growth rate in the money supply. That's pretty hot. But the 3-month rate of change is starting to roll over and head lower. What is interesting is commercial industrial lending on a year-over-year growth rate. Growth fell down to 6.14%. Now, in the past, I pulled up my actual Excel spreadsheet to show the breakdown of the numbers. Like, why don't I just copy this box down here and give you the numbers, make it a little easier for me. So we did that. 6-month rate of change is down to 1.27%. So that's looking at a 2.5% growth rate. That's a lot lower than 6. So you double that to get roughly the annualized. And look at the 3-month growth rate. This is effectively telling you it's growing at a 2% rate. And this is interesting because, and let me go find the chart on that. There it is, and we gotta switch. Here you go. So you see commercial industrial loans, all commercial banks. This is the live version, 10-year Treasury yields. So you can see Treasury yields are telling us that commercial lending is going to fall. It's going to, and usually when commercial lending breaks below its zero bound over here, you're already in a recession. Let's see that. Oops. Let's see. There we go. So you can see as it's falling into a recession. So the 3-month rate of change is critical as it crosses the zero line, which it did briefly a couple months or so ago. But when it does, that tells you recession is inevitable. Let's move on. Do I want to? Yeah, let's get through the PowerPoints here. Consumer loans, despite a big surge in credit card borrowing, we're not seeing it here, at least on the Fed data from last week, up to 3.96 annualized. You can see the trend is weakening. The consumer is stressed. They're just not buying as much. They can't afford as much. And that is what happens when the economy slows down. Take a look at this 30-year real estate, we looked at this, I think, Wednesday, could be wrong. Real estate loans, all commercial banks left 30-year fixed rate mortgages. You can see the interest rates are not, these low interest rates are not causing an increase in demand in housing. I'll give you another look at that here shortly. Car sales and consumer sentiments, you can see car sales are falling, but yet consumers' view of the economy isn't. So it kind of tells you, well, your sentiment along with stock prices about to crash. Well, lo and behold, someone actually put that chart together. So here's new car sales. Here's a New York Stock Exchange composite. Oh, so either car sales are about to head higher or the market should go lower. We looked at this already, the positioning of gold. And then the last slide we've got on this is a core CPI on a year-over-year basis, which is headline inflation versus money, M2 velocity, speed at which money is exchanging hands. There's the velocity of money leads CPI by 18 months. Today on Twitter, there were some professionals who seemed to know a lot more about CPI and said, hey, an economist saying, look, this last late surge is typical going into recessions. And so this chart was interesting. You see there's this last kind of surge, boom, and then look at here back in the 2000s, kind of late, and then boom, lower. So everyone who's getting excited about inflation, the velocity of M2 tells you otherwise. And yep, that should have cleared that out. You gotta look at me for a second while I close that out and get some stuff adjusted. Here we go. Okay, let's take a look at assets and liabilities of commercial banks. Let's see where we're at. Treasury and agency securities increased just by $2 billion, so not a whole lot. In terms of mortgage-backed securities, only $1 billion increase, and U.S. Treasury securities increased by $2 billion. Now, I did find out these other securities, these are mortgage-backed securities, are not insured by the government, so there's a slight increase there. And these are other agency or a type of bonds that are not U.S. government securities, and you can see they increased that by $7 billion there. So a little bit of increase. The banks are still buying bonds. This is critical. The banks are still buying bonds despite the market driving interest rates up. Let's take a look at retail sales. Big crash in today's retail sales report. And this is not a good sign. We've seen that when retail sales break this 3% line, it usually spells bad news for the economy. Now, there isn't a lot of data on retail or food restaurant sales because it just hasn't been around that long. It's been this is the earliest data, 1993. But you can see the dot-com bubble, there wasn't a collapse, but look at what happened during the great financial crisis. And here we go again. We had a very large move down, and that is not a good sign for the overall health of the economy. Let's take a look at the NASDAQ McClellan Summation Index, and liquidity conditions are back above zero, but not very strongly up given where the market is sitting. So liquidity conditions should be way up here, showing the market is flush, and it's not. I mean, if this rolls over, at some point we get a big flushing move down, and I do expect that to happen. All right, just making sure you're seeing what I'm seeing. Okay, now let's try to answer the question of the Fed cuts. What do? You own bonds. Do you sell them and panic? Do you hold on to them? Or do you use it as an opportunity to increase your risk? So what I did, and we've seen a similar chart to this, but I pulled the effective federal funds rate and I made it in really dark blue. So that's a thicker blue line. And then I put 1, 3, 5, 7, 10, and 30-year yields. Now let's do this. Is there any point where the federal funds rate is decreasing and yields are going the opposite direction? No. And you say, well, maybe right in here. They're still headed down. What about here? They still headed down. So there you go. No matter what anybody tells you, when the Fed lowers the federal funds rate, it does not cause interest rates to rise, period. Now, it doesn't mean market participants will drive rates higher. It just is not going to drive rates higher. And this does not like that I have all this data sitting on here at all. Let's zoom this back out. So what can we glean from this? Well, you can see when the federal funds rate starts to go down, it's going to be annoying. There are periods in this slope, and I'll move this out of the way, where you'll see the market will push rates back up. And you can see it here. And so let me move the mouse out of the way. You can see there are periods. The little thin red line, that's 1 year maturity. The little green line that kind of follows it is 3 years. So you can see short-term Treasury bonds follow very closely when the Fed lowers interest rates. The longer-term maturities, when you go to the 5, 7, 10, and 30, the market tries to push back on that. You can see that right here, and you can see it here, and that's where it bottomed. So you can see that it's not unusual and should be expected that when the Fed is in the beginning stages of a cutting cycle, that if longer-term yields drop faster than the Fed is cutting, which they are, the market will push back. But the market will ultimately be wrong because when the federal funds rate falls, all yields eventually go down. So that should put to rest one of the biggest questions. Oh my God, the Fed's going to lower rates. I better dump my bonds. It certainly doesn't look like that on this chart here. In fact, it would tell you just the opposite. Okay, let's move on to the next thing. And we talked about, I want to say on Wednesday, I blink, the world dollar liquidity. And I felt like I didn't get enough of this that I wanted to talk about. And I was really thinking about world dollar liquidity and interest rates and all this stuff the other night. And I had an epiphany that there's even more to this than I even realized as I was really kind of breaking through what this really actually means. And so I'm going to write more about that for next Friday. But I still want to go through this again just to make sure, and it helps me, and maybe it'll help you, because if you don't remember. But you can notice, now world dollar liquidity, this is when it began. Why does it begin in 1971? Because we went off the gold standard. That's why this all of a sudden matters. And you'll notice when it contracts, but not every time, following is a recession. You see in the great financial crisis, it didn't contract. But look down here, 2016 was the only time in history that the year-over-year rate of change in world dollar liquidity contracted, and we did not have a recession courtesy of China dumping a massive amount of its dollar reserves into the global economy. But look at it here, it's contracted again. So it tells us that a recession is inevitable based on this chart. Now, what this is made up of is federal debt held by foreign and international investors. Mostly, it's going to be mostly foreign central banks. It does not mean it's all, but mostly, because they buy a lot of bonds. And the adjusted monetary base, which is all the currency in circulation, plus currency held in reserve by commercial banks, large commercial banks. And those reserves were put there by the Fed during quantitative easing and removed partially from quantitative tightening. So let's look at the breakdown of this. So you can see, why did world dollar liquidity start to contract? Well, foreigners on a year-over-year basis were not increasing or decreasing. They were just flat. So they were not adding to their U.S. Treasury bond holdings. Some countries were selling, some countries were buying, but the net result was fairly flat. It's important to note that in terms of dollar liquidity, this needs to rise. It doesn't have to be a lot, it just needs to increase. Let's look at what the Fed did. Now, here's really where the problem is. I want to just pause for a moment. A lot of people think the current economic slowdown has something to do with the tariffs and trade war. It doesn't. In fact, when you understand world dollar liquidity, the trade war could end tomorrow. And yes, there'd be a lot of people excited, hey, okay, rally, and that nothing would change. What has to change is either the Fed has to ease to put more dollars into the economy. Like, what are we looking at here? Maybe we should just back up and just kind of remind you, what are we looking at? When we were on the gold standard, countries could leverage paper currency against a brick of gold. So they would say, okay, for every X ounces of gold, we will print X or Y dollars of currency, paper currency. So it's backed by gold. When we went off of that, the dollar became the gold standard. There's a reason why it's referred to that, is because it replaced gold. Now, the problem people had with gold, when I say problem, I mean governments and central bankers, is they said it was limiting the growth of the economy. No, it was limiting their ability to borrow and spend. That's what it really did. So to promote economic growth and debt and raising asset prices, they had to switch to something that we could print, because we can't print more gold. Now, granted, our planet is completely surrounded by gold. We just can't dig that deep, and we may never be able to. So there's effectively a finite amount of gold. So as the global economy expanded, they felt that that was a limiting factor. We needed to go off it because, hey, we can always just print more dollars, right? Turn on the printing press. Hey, look, economic expansion. How fun is that? So gold, or the dollar, became the gold standard. So throughout the world, you can almost just vision the world with a super highway of dollars just circling around it, okay? Everybody, for the most part, has their currency pegged to the dollar. When you shrink world dollar liquidity, or this dollar superhighway, as I like to think of it, global trade falls. It slows down. And when global trade slows down, asset prices go down. And we're seeing that in the real estate market. The only reason we're not seeing it in the stock market is because we had a tax cut that is pretty hard not to say that it was designed to get corporations to buy their stock back to prop up the market, because they certainly have not done hardly any CapEx spending with it. They've done mostly share buybacks. So as this dollar liquidity highway, think of it like an 8-lane just super highway of dollars circling the planet over and over and over and over again, and you cut down a lane, and then you cut down another lane. What's going to happen? Global trade is going to slow. Do you see it? The tariffs just add to the problem. They aren't the problem. If you want to point to who the problem is, simple. It's the Federal Reserve. When they decided to enter quantitative tightening, they reduced part of the formula. They reduced, okay, we look over here. Remember, foreign held debt plus the monetary base. So here you can see the monetary base deeply contracted. It never has contracted this much in history, ever. So what was the solution to the problem? Well, if you understand the formula, that means foreign investors and central banks needed to go and borrow or buy more U.S. Treasury debt, and they didn't. So now what are we seeing? Foreigners are starting to buy U.S. debt because clearly the Fed's not doing it. The Fed is going to move last. Why are they going to move last? Because we're an importing nation. We see the problem starts over, say, Asia, the exporting countries, and by the time it gets here, there's a lag. So we don't see the problems. I mean, ask most Americans, you think the economy is fine? Yeah, I think it's great. Go over to Asia and ask them, do you think the global economy is great? No, because we see it last. Part of also the reason why American investors never know when to get out of the market is they always see it when it's too late. You want to know what's coming? Look at Asia and Europe, and you'll get a really good idea of what's about to get here. So because the Fed is using the same data we're all looking at that is lagged from the global economy, they always cut too late. You'll hear this happen. The Fed's behind the curve. Fed's behind. Yes, they are. They are right now, and we know it because we understand world dollar liquidity. A lot of other people don't. You're not going to find hardly any professionals talking about this because they either don't know it exists, and if they did, they don't understand it at all. So to fix the problem, foreign central banks needed to take their dollars that they've got stored up and buy our debt, and they didn't. And now they're starting to because they have no choice. You want to get this engine restarted, someone has to start buying U.S. Treasury bonds. So when we look at this, what's really powerful about understanding this, if you are invested in U.S. Treasury bonds or thinking about buying them, you can see that federal debt held by foreign and international investors on a year-over-year basis is now growing at a 6.6% rate as of last quarter, meaning they are adding bonds. They have no choice. But as they take their dollars and send them over here, guess what it does to their economy? It slows it down. Now, why does it do that, you ask? Because let's say I'm a producer or manufacturer in Asia, and I need oil. Well, how do I get oil? I need dollars. So I go to my bank, say, I need some dollars. Oh man, Steve, dollars pretty expensive right now. What? Yeah, we went to the central bank, and they don't have a lot of them right now either. So the cost for me to get those dollars goes up. And if I can't sell them because the global economy, or if I can't sell my product because the global economy is slowing down, I don't buy it. So again, in order to keep this machine running, there actually needs to be a consistent growth of dollars in the global economy. And there's not. And that's part of the reason why when this happens here with world dollar liquidity, you get a recession because someone has to start buying our debt. Well, one, it's going to be foreigners. It will eventually be the Fed. Do you know who the other person's going to be? All the people sitting in the stock market. They're like, there's no way. Yep, it's going to happen. Here is the same chart, world dollar liquidity, with 10-year Treasury yields inverted in red. And you can generally see when foreign central banks, the Fed are buying bonds, interest rates go down. Now they're inverted, so they're showing going up. But look at this. You want to know why interest rates started rising here? Foreigners started buying bonds. Isn't that pretty cool? And if you're still worried about all of that, I totally get it. How about this? U.S. and Treasury agent securities. You know what? That just reminds me there was something I wanted to show you here. Anyways, you can see U.S. Treasury agent securities, mortgage-backed securities, all commercial banks inverted against 30-year Treasuries. And you can see this pullback is not being validated by banks dumping mortgage bonds. So it's a short-term pullback. So it tells you this is something you want to look to buy. Now, what I thought was really interesting is if interest rates are going up, that also must tell us demand must be going up, right? Okay, residential real estate loans decreased by $1 billion last week. Revolving home, and where did that come out? Revolving home equity loans dropped a little bit, and closed-end residential loans fell. So there you go. All the people that are panicking and talking about inflation and interest rates going up, it's not backed by demand, it's backed by speculation. Hence why we will most likely see that when we look at what's going on with the hedge fund managers next week. Let's take a look at some charts. We got not a lot of time. S&P 500 got stuck trying to make a run at its all-time high. This is very interesting today because when we look at volatility, again, you don't trade this, but volatility today dropped about 2.5%-ish, somewhere right in there, and the market only went up like maybe at 0.2 or 0.3% at one point. So what was happening, investors are selling volatility, and they were selling it to try to drive the market higher. Didn't get it. Now, what's interesting about volatility when it gets this cheap is volatility is bought by, say, pension funds, large institutional managers, people that manage a boatload of money, and they do it because they can't sell their entire book off near the peaks. So they have to hedge. Well, when volatility gets cheap, people buy it because it's a cheap hedge. And this was briefly around, but it used to be around a lot back. We had a chart going back 2008. This thing used to trade in the tens of thousands of dollars per share. Today, it trades at 23. So if you were looking, let's say you're a big pension fund manager and you were looking to hedge your equity exposure, this stuff is cheap. So one of the reasons markets reverse directions is because stock prices are getting stuck, can't go up. And professional money managers say, hey, you know what? It's pretty cheap to go and hedge right now. I'll start buying some hedges. No, and you do that knowing that a lot of people are just short volatility. So you get an unwind as short positions get pushed out. 10-year Treasury yields backed up to this major level of support here. Let's zoom this out and see, why isn't this a big deal? Well, there's a couple reasons. One, okay, yeah, it did cross its 50-day moving average. Inevitable, that was likely to happen. But look up here, there's a lot of support right around this 1.9%. Now, I will also show you this. Let's go back and look at other major sell-offs. So you can see there's periods where back in 2011, it came down, crossed up over the 50-day moving average. People got excited, and then boom, boom, collapse. There are other, back like here in 2007, you can see it came down, tracked 50-day, got across it. People get excited. Nope. Crossed a little over it. Nope. So look, when you know the Fed is cutting and you're in a cycle where interest rates are headed lower, these back up in yields are called opportunities. So let's say you don't own any Treasury bonds and you're thinking about, well, this is going to give you an opportunity. Let's say you own some and you think, man, maybe I should increase my duration so I can get a bigger return. There you go. You start seeing this. So let's look at 30-year yields. They got backed up as well, and they're getting into a zone of heavier resistance in here. I don't have a line, but they're getting there. And it doesn't mean it has to run up and touch its 100-day moving average. Sometimes what you see on these charts is that it looks like a touch because at some point it reverses and the 100-day moves down and actually tags it. Let's look at the bond. Let's look at short-term bonds here. These have sold off, but look, there's a lot of, let's draw a line and move it down. There's a lot of buyers back in this zone. So it tells us this isn't really overly risky, that this isn't a big pullback. And besides, when the Fed cuts, and they're likely to cut next week, there's a 100% probability with Wall Street. Now keep in mind, Wall Street is priced in a 100% probability of a 0.25% cut. Do you know how many times the Fed has disappointed Wall Street? Not many. In the history of the entire Fed, very, very, very few times, and almost none, does the Fed not follow Wall Street. So the fact is, let people dump these because the Fed on next Wednesday is likely to announce a cut. Let's look at the 7 to 10 year bonds. These are getting backed up into kind of a zone right in here where there's a lot of resistance. Support, where people that have previously bought or sold have switched, maybe if they're buyers, they've held, and if they've sold here, they've become buyers. This is likely to start firming up in here. This might dip a little bit more down into here next week. It wouldn't surprise me. Now, I want to show you some on the long bond that you really kind of see. So today we had a fairly decent amount of volume, and this position came down May come down further, but look right here. There's some decent level support. There's a little bit better support down here. But how you know you're getting close to bottom is you get a shoot of volume, and then price falls, but volume starts to slow down, and then kind of bottom, and you get that bottoming effect here. So you see every time there's kind of a waterfall drop, you see this big jump in volume, and we're seeing it here. What is happening is that people that bought this, maybe up in here, put a stop loss down here somewhere, and it triggered the stop loss, and it creates a flush of volume all at once. So if you know where all the stop losses are at, or you want to find it, sometimes even the big players who want to buy more bonds will push prices up, bring people in knowing that they're going to put stop losses on, and then they're going to flush them out. Now, why would they do that? Because they know weak players use stop losses. They know the more money someone manages, they don't use stop losses. So I don't use them because I can't. I could, but I got in trouble. Seriously, I got a phone call. Why do you put in a stop loss? Too big a position. You can move the market. Don't do it. So the big players know that when you get a lot of little players and they stack up a bunch of stop losses, all you have to do is plow right through them, trigger them all to sell. You can buy up their inventory, and then you can move on. What they're looking for is, are the bigger players, and we're not big, but comparatively to small players, but are there people like us that hold these are going to sit on them? And that's what the smart money wants to know, is who's with us. So we're going to shove prices down, flush out the weak hands, see who's the real deal, bottom out and go, because you just saw all the evidence that you need to see. When the Fed cuts, interest rates across the entire curve go down. And backups like this become opportunities to take on more risk. Now, could this get down here? It certainly could. I thought right in here would be a buying opportunity, but I'm not going to buy what's called a falling knife. If this thing's falling, we'll let it fall, and then we'll readjust the portfolio. So how much longer will it go? Don't know. We may have to wait until after the Fed meeting for this thing to stop, but this volume here is good. What it tells us is, again, a lot of these players here are holding small hands, weak hands, and have become sellers. So based on this here, I'm going to predict there'll be more selling going into next week. Wouldn't be surprised. This gap did get filled. This gap was an overnight gap. So during Asian or European markets, this went up. So the market's coming down to kind of see, are these hands strong? I'll tell you where the strong hands are. They're right here. How do we know? Because when we zoom out, you can see this is a heavy level of support. If it gets down to 132, it probably will hold because there's a lot of support here. So flush out the weak. And this is not unusual. When you get into a bull market breakout, it starts to go up, and then it flushes the weak hands out, and then it turns around. This is totally normal. Nothing to even panic about. Let's take a quick look at the ags. We're getting a nice little bottom here, increase in volume, broke support. So we'd like to see this kind of move up and flush some of these hands out. There's a lot. The next major resistance level isn't until up in here. So we'd like to see if get some of these people flushed out, and that'll be nice. So anyways, we're a few minutes over, but let's wrap this up until Monday. We'll take a look at how the hedge funds are positioned, and that won't even tell us the whole story of how they're positioning after this week. We'd have to wait the following week. But it's nice to know the commercial banks aren't selling. There's no reason to believe the foreign central banks are selling, and we know the Fed's not selling because, well, they're about to buy next week. So what's cool is when you see speculators with deep short positions going into pullbacks like this, you got to get excited, because you now know when the Fed cuts, it's good all the way around for anyone that owns Treasury bonds. I'm Steve Van Metre. Hope you have a great weekend. I'll see you Monday. Bye now.